We did see
Good
the
morning.
sell-off yesterday. We've seen the sell-off, I hate to say it, not just yesterday, many days and many weeks now. When does it come to an end, and does it in 22, or is this a 23 event?
You know, yesterday's FOMC meeting was a tough pill for markets to swallow, and I think this likely continues for three reasons that came out of the Fed. They're talking about higher inflation, higher interest rates, and higher unemployment. They talked about unemployment going up by 0.7%. Historically, that's always led to a recession. Inflation is sticky. Shelter prices is a huge component of it, and that's much hotter than it was pre-pandemic, as well as higher food and healthcare costs. And then, of course, interest rates, 125 basis points before the end of this year, and then again throughout 2023, higher rates. All of that, I think, is challenging for the markets.
Okay, Sarah, can I ask you, to me this is a hard question because I know the answer is supposed to be you're not supposed to do anything about it, but then I think maybe you are. If you are convinced that the market is going down, which it sounds like everybody seems to be, but unfortunately that also is also like the conventional wisdom, which often seems to turn the opposite way on you. You would say, and you were owning indexes, you'd say, I shouldn't be owning these things right now. And you'd say sell, but typically we say don't do that, hang tight. What would you do?
It's challenging because people who try to market time usually lose and buy and sell at the wrong time. So we're looking for areas that are more resilient in this kind of economy. For even in equities where we're not really bullish. Dividend growers look relatively cheap versus some of the other areas. They have more resilient balance sheets, and you can get income while you're waiting through this pain that we're going through. Also, outside of equities, we like high yield. That looks attractive with over 8% returns. People usually think high yield is higher on the risk spectrum, but the companies within that area look higher quality than they used to. We think they're survivors. And then outside of public markets, areas leveraged to inflation like farmland and even private real estate, where they have inflation escalators within their contracts. So we're about how do you position your portfolios to win in this environment rather than moving to cash and then trying to time your way back in, which can be a challenge.
But it sounds like you are relatively, therefore, negative on equities. We'd had this conversation a year ago. I think you would have been pretty heavy on equities, no?
I mean, a year ago, I think, we were still looking to see how sticky will inflation be, and it was tough to determine how much of the issue was supply chain versus demand issues. Now you go forward and what we've realized is that inflation is going to be here for a while, and the Fed has to continue to increase interest rates. That is a headwind for equity markets. There's other areas that still are shoes to drop, such as earnings. We're seeing third quarter earnings estimates start to decline so far by about 5%, but still positive earnings growth for the rest of this year and through 2023 is a challenge for the markets, along with the strong dollar. I think it's just more challenging now even than it was a year ago.